Henry Peabody, year to date, your Eaton Vance Multisector Income Bond Fund is up almost 19%. It's the leader in its Morningstar category. So what are you doing that some of the other bond fund managers aren't?
Well, by trade, what we do is we seek value in fixed income. We look to flip the returns of fixed income really on their head, buy bonds when they come to us, and seek out discounts. In Q4, Q1 of last year, we were offered a tremendous opportunity to buy fallen angel bonds, energy, commodity related, at very discounted prices, and we've held on to the lion's share of those positions through today, and they've served us very well.
Are you finding a lot of value in the market right now? Because people are saying that bond prices are so high that there's no value out there.
There's very little value. We maintain about a 10% cash position, and we've been exiting positions that are fully valued or long duration. We think that volatility will probably increase, and that's why that cash position is so important to serve as dry powder.
And I think about half your funds in corporate bonds. You did very well with energy issues. It seems like you let them run. You own names like Petrobras and Ecopetrol. Can you talk about your energy allocation?
Our energy allocation is mostly in the high-grade space. We avoided much of the high-yield E&P space last year, which was a real problem area. That allocation has served us well. We've been exiting some at the margin. Our position in energy has come down over the year as energy prices have rebounded, but we feel comfortable with our holdings now.
And I named two international players in your portfolio. Can you talk about your international holdings? Because it's an international fund. Because there's so many crazy things happening with regard to central banks. We'll talk about in a second. But talk about how you're dealing with the political risk out there.
You hit on a very important point. Political risk is just as important as anything else today. Trying to get a gauge on what's happening with foreign central banks, with foreign political regimes, is another lever to pull to avoid traditional rate risk, which is what we're trying to fight. Places such as Mexico and Brazil offer opportunity for upside in both currency and potential rates coming down, offering a dollar price improvement on those positions.
All right, now let's talk about those wacky central banks. You're seeing negative interest rates in places like Germany and Japan, and then you're seeing our own Fed talking about raising rates. So there's a divergence there. Talk about how you manage that as a bond fund manager.
Well, first of all, you have to avoid overpriced risks. When you talk about developed nations' government bonds, there is entirely too much risk for the return there. Avoid that traditional rate risk. Now you've seen a shift in central banks with the Bank of Japan, with the ECB and the Fed, all talking about steepening curves a little bit. It adds risk to that traditional bond space. So what we do is position for a weaker dollar, have cash for volatility, and be ready to put that cash to work when it emerges.
All right, and what happens if and when inflation emerges here in the U.S.? Because that is what everyone's looking for with regard to our Fed.
That's key. Inflation seems to be one of those risks that the market does not appreciate now. It's starting to become a page one story. Wages are increasing, energy prices are increasing, the labor market is tight, and we expect that will continue. However, with a sub 2% 10-year note, there's entirely too much risk there. That's why we look at foreign currency, for example, as a way to trade against a weakening dollar and rising inflation rate.
All right, thanks a lot for coming on and talking about your fund, Henry.
Thank you very much.
Thank you for watching The Street.